Oh, thanks, Aaron. I appreciate it. This is about as timely of a meeting as we can have right now for both, I think, crops and cattle. Uh, I mean, there's a lot of things that are moving and shaking right now, and these markets are. Aaron's already mentioned the volatility, and they definitely have some volatility in them. But in that volatility, there are a lot of opportunities being presented through that volatility, and it's a matter of taking advantage of those opportunities. Aaron talked about not pricing yourself out of a rally of some sort. At the same time, if you know what your cost is going to be and you have some idea of something, and I'm speaking from the livestock side mainly here because as far as crops are concerned, we don't even have anything in the ground. Um, but but if you know what it's going to cost and volatility presents you a price opportunity that's going to make you money, there's nothing wrong with grabbing that profit and moving on. And there's a lot of ways of doing that. And I'm glad Aaron mentioned some puts because I'm gonna briefly talk about. I don't have necessarily slides on them, but I'm briefly talk about some price risk management ideas that some people might take in the near term. So up front, really talk about the fact that calf prices are really starting to take off. And 2 weeks ago we had ice and snow across 2/3 of the state. At least everything west of the plateau had some type of ice and snow, and that really slowed cattle movement. It also puts a damper on people's thoughts on what they want to do. But when you start having the weather that we're having right now, uh, a full week of 60-degree weather, sunshine every day, grass starts to green up. We've already started to see this slow improvement in calf prices. I do suspect over the next 2 weeks, 3 weeks, we're really going to start to see calf prices really take off. And I'm talking about for, lightweight calves, anything under 600 pounds, probably for sure anything under 550. Feeder cattle prices are fair. They're not the best. They're not the best as far as on a cash basis. But the futures market is offering some opportunities a little farther down the road, especially in those summer and fall contracts for folks that will have cattle in the summer and the fall. And there are some opportunities for margin operators right now. The cattle feeder things don't look as peachy, but for most of the folks that we have in our state that are running stocker operations or that are just backgrounding their own calves, uh, there are some opportunities to grow these animals. So looking at what has been happening in the slaughter cow market, we think about what drives the whole thing. And of course, Aaron mentioned it earlier in the crops. Demand is the driver. Uh, it does not matter if you don't have demand, a product is worth nothing. And so demand is in the form of beef. But when we bring that back to the closest farm gate thing we have would be slaughter cattle prices. And what we know is that the Packers have been exhibiting their power over cattle feeders for several months now. Pretty much ever since coronavirus hit, they've been able to exude some power because that got cattle feeders behind in marketing cattle, and uh, they can continue to use excuses of the retail, not the retail, but the food service and restaurant industries are slow. And so we've been very, very stagnant on slaughter steer prices for the past month, essentially. We would expect these prices to at some point start taking off in the spring. Um, April and May tend to be good months for that market, and so we'll have to give it a little bit more time because being stagnant this time of year is not unheard of. That we're looking at 2021. You can look at 2020, and you can just see exactly when coronavirus really, or the pandemic of coronavirus, or the scare of coronavirus, however you want to look at it, really took hold of this market and sent things into some gyrations that we don't normally see. But if you look at that 5-year average, you can see where April and May is kind of where these prices tend to peak. And so we do have upside potential, probably reaching as high as 120, or maybe a little higher than 120 on finished cattle moving into April. It's going to be it's going to be a long road to hoe to get there, just because leverage is still with the packer. But some of this bad weather that went through cattle feeding country reduced weights on these cattle. You know, when you go through a week, 10 days of a lot of wind, a lot of cold weather, cattle will not perform as well. So that's going to end up in lighter weight cattle. Going to be cattle, not as many cattle coming off feed during that time. So we will have some leverage from the feedlot standpoint. Looking at just 5 and 6 weight steer prices, it's hard to use the past 2 weeks of data. It's on here. The price data is on here. It's hard to use those 2 weeks for these animals, primarily because we just have not had a lot of animals go through the market because of ice and snow and then a lot of rain. You know, last weekend, not this past weekend, but the weekend before, you know, really, really wet, a lot of moisture still out there, slowed down early week auctions. So, you know, it's hard to use that last 2 weeks of data, but we put it on there anyway. And we are seeing this week, the early auctions this week, Monday, Tuesday auctions are showing some really positive price improvement in these lightweight calf prices. The one thing that has held steady and constant from the fall through now is there continues to be improved demand for preconditioned cattle. Preconditioned cattle, preconditioned cattle, preconditioned cattle. Normally in the spring, the premium for those weaned and vac cattle starts to wane a little bit relative to other those that are non-weaned, because people are looking for cattle. But this year, that we've not really seen that same collapse yet, that narrowing of that price spread. It is evident that people want preconditioned cattle. So you can take that to the bank with you. It's worth some money because that's what stocker and backgrounding and feedlots are looking for. 7 to 8 weights. You know, we've seen a slow uptick in this. A lot of this is driven by that futures market. The futures market, the nearby contracts I'll show, I think I've got May, and I'm going to show May and August. But really, you think of it as in the spring contracts, which would be March, April, and May. And then you think about the summer and fall contracts, which would carry you from August through November. Two totally different beasts. The optimism that was in the spring has about disappeared. The optimism for summer and fall is still very, very strong. And so we're looking for these prices to slowly increase through the end of the spring and really strengthen towards the end of summer or middle of summer and going into the fall months. And we'll show those projections. But right now we're really languishing from where we think this market will go. The bigger issue comes back to the crop side. It's hard to explain why feeder cattle prices are increasing at the same time corn prices are increasing. It used to be, you know, those had an inverse relationship, and that was because corn was our primary feed source. Now you know, in the past 10 years, we've shifted such that just corn itself is not the primary feed source. There's a lot of corn byproducts or co-products that go into feed resources. So we can't always just look at corn and say, well, it went up, so feeder cattle went down, or vice versa. So those things right there, it's still hard to, regardless of how we've changed feeding cattle or what we're feeding cattle exactly to make a TMR, you still want to hinge on the fact that, hey, if corn prices go up, we would expect feeder cattle prices to go down. And that has not been the case, because we move out of the $3 up into the $5 range on corn, and feeder cattle prices increase. And so when you look at that, you say, well, is just demand that strong for cattle such that higher feed prices don't offset that demand? You know, I don't know what the correct answer to that question is, but there is some strength somewhere, and there's a lot of optimism because people continue to eat beef. The really, really strong movement in prices has been in slaughter cow prices. They've been exploding just like they did last year. I very well can see these animals getting up over 70 cents a pound. For folks that have slaughter cows or that are in the stocker cow business instead of the stocker calf business, there are going to be some opportunities here to market those animals. When you can get a salvage value of 70 cents a pound, uh, that is a pretty stinking strong value on slaughter cow prices. And so we expect those to keep on moving. And what has been driving that is coronavirus has really tremendously helped that, because we look at a lot of ground beef demand, and a lot of that ground beef is coming from these animals. And so there's a high demand for the beef that's produced by our slaughter cows. So far, slaughter year to date, heifer's been up, steer's been up, and beef cows have been up compared to a year ago. And what when you start thinking about what is that going to do to inventory, uh, what should that do to cattle prices? I think if we maintain these type of slaughter levels, which I think we will throughout the year, it's going to bode well for cattle prices moving into 2022. I think we're going to see pretty decent prices throughout 2021. Now that's compared to 2020 when things were just in complete disarray. But as we go into 2022, and let's be honest, it's not that far off. I mean, we've already made it through 2 months of this year, and every year goes by faster and faster. And so when you think about this, 2022 may be setting up to be a really, really strong year in the cattle markets. Uh, as we reduce, if we keep on killing more heifers, if we keep on killing more cows, we're going to have a smaller calf crop this year than last year if this maintains itself. So that's something to keep in the back of your mind as you make plans. Meat production, beef production, and pork production are both up a little over 4%. Aaron was talking about the outlook, USDA projecting increased beef, pork, and broiler production. You see here where we got broiler production down 5.5%. That is strictly because of the last week of data, which happens to correspond with ice and snow in much of bird slaughter country. It's not that often that most of broiler production takes place from Arkansas down into Alabama, down into Georgia. So when you think about those three states, and the fact that a lot of broiler production takes place through there, a lot of these places were slowed down 2 weeks ago because of snow and ice conditions. So when we're generally produced, well, I think we produced about 60% that week of what is normal. So if that number was not in there, broiler production would be up probably around 2% or so. So there's going to be a lot of meat on the market in the short term. That should put pressure on prices, but longer term, we're probably looking at something in the beef market to support that beef market. I'm not sure. I understand why pork production is up and why we continue to expand pork production. A lot of that has to do with China. What I don't understand as well is why we continue to increase broiler production. Things don't look as good in the broiler industry and the chicken industry as it does in the pork and beef industry right now. So I'm not exactly sure how those decisions are being made, or why they're being made. I have to dig a little deeper on that. Again, a key for having all this meat, we can't consume it all domestically. We're going to have to really push exports. Pork exports have been strong, nothing to worry about there, and we've been very fortunate that beef demand is really, really good. We thought with coronavirus, that's all you heard was now that we don't have restaurants open and food service industry is shut down. But it is amazing. Folks have been buying beef in the grocery store. People like beef. That's it. I mean, I've actually got to do a lamb talk tomorrow. And, this country used to have a lot of sheep in it. And you wonder why things got crossed over more into cattle than into sheep. And it's pretty simple to see because consumers in this country demand beef and not lamb. Don't get me wrong, lamb is a great eating experience and it's delicious. Um, but we as agricultural producers produce what the people want, and beef is what it is. So, um, there's still when we finally open the market to beef going to China, we have not really seen some substantial, huge increase of beef exports. But just the fact that we can get rid of a lot of pork that way, uh, Aaron's already talked about corn and soybeans. Those products are going. Uh, what are they feeding over there in China? Well, that all that corn and soybeans is going to feed a pork consuming nation. They used to have essentially what we would call backyard chickens. They had backyard pigs, and that's kind of how their pork production was geared. Now they're very much, since the African swine fever wiped out, decimated their hog herd, one by one by one. They're industrializing or commercializing pork production, much like what we've done in the United States. And so now they have a lot higher demand for corn and soybean products because they have a more regimented uh, feeding situation. It's not whatever came off the table, the scraps that came off the table. We're making a conscious effort to provide the feed resources that will grow these animals at a consistent rate. To some degree, you can say the way we've grown hogs in the United States, we've I tell you, I put it this way: for Andrew Griffith, eating a pork loin is not that exciting to me. We've bred out all the fat that goes into the loin of a hog, and so I don't enjoy it. I still like bacon, I still like sausage, um, but we've bred to make a lean loin in pork. And I always had a professor in undergrad that said the flavor's in the fat, and there's a lot of truth to that. Um, and so we'll see how China, how they change, but they're going to always be demanding a lot of corn and soybean products. Japan and South Korea remain strong markets for us, and we're still looking for some more improvement in Mexico. Things really slowed down in Mexico after coronavirus, and things are picking up, but we need them to get back to normal. Uh, Imports, they're really strong because back during the middle of the pandemic, again, we were looking for grinding beef. They've come back to normal levels, no big deal there. Exports have still been strong. Again, a lot of stuff going to Japan, a lot of things going to South Korea. Canada and Mexico remain strong markets. Hong Kong is a strong market. Um, and so exports are looking good, which should support market prices moving forward. Um, Not too concerned about that. Meat prices. Um, this this graph does not show the change in boxed beef prices very well because of last year. We have this huge range here, but if we just look at that short blue line, and you can see where we were trading around $2.10 a pound, and we've moved up to nearly $2.40 a pound uh, on boxed beef. That $30 increase is a huge increase. That is as much variation as we typically see in a year, and it's been in a 2-month period. Um, we haven't even, January and February are typically some of our softest demand months for beef, but there is strong demand for beef. It's going to remain strong. I don't see any reason why it would knock off. I think we'll start to see more retail and food service business. Um, I say that because I noticed the past 2 or 3 weeks in church, we have had more people come back to church the past 2 or 3 weeks. And the reason for that is because a lot of these people have had their second round of the coronavirus vaccine. And so 2 weeks after their second round of the coronavirus vaccine, they feel more comfortable getting back amongst people. So I just noticed that in church, I suspect those same people will feel more comfortable going back to restaurants, going back to other events. I think that's what'll happen. They're not gonna be as gung ho to get out there and eat, maybe as going to their church, but there are gonna be more people. I drove by Logan's the other day, and it was a packed house. I mean, you couldn't have found a parking spot in that Logan's. So I think we're going to see some more of that heat up. But what's really going to heat up here in the next few weeks is we're going to have summer grilling season, and people are tired of being cooped up in the house. They hadn't spent their money on anything. Their discretionary spending has not gone to vacations because, well, we can't travel if we don't have this and we don't have that, so we don't go anywhere, and nothing's open anyway. So what are they going to spend their money on? Well, might as well buy the best steak I can find and throw it on the grill come, the Memorial Day holiday. That whole Memorial weekend will be filled. So we should see some strength in that. I do want to make specific note of the Choice Select spread. Typically this time of year, we see the Choice Select spread narrow. So we see Choice and Select prices get really, really close together. And generally we get down to $1 or $2 spread in a week for a weekly average. We have not seen any such thing this year. My point in this is, and this is with increased Choice and Prime beef production relative to Select. So when you think about supply and demand, we've increased the supply of Choice product and reduced the supply of demand, or the supply of Select product. Well, if you did that and demand was exactly the same for each product as it had been previously, then we should really start to see a narrowing of the Choice Select spread. What I think is, I think what we're finding is consumers really, really prefer Choice grade or higher beef. That's what they prefer. And that means Select grade beef is pretty much in no man's land. It's out there in no man's land. So cattle that are grade and Select, when they're getting slaughtered, not going to be much value, and that value is going to continue to decline. So just something to think about as you make decisions as far as genetics and animals that are going to the feedlot. Aaron he put a lot of focus on the corn and beans, and we talked about how that influences, feeder cattle prices. I don't know if anybody looked at inventory numbers, but Colorado was where the biggest decline in cattle inventory occurred. Huge numbers. It's evident why there was such a decline. Terrible drought continues to hamper the western part of our country. This has been sustained long-term drought. Sustained long-term drought. That's not major cattle feeding country, but there is a lot of national grazing lands out there that that people lease. And it's not the hugest number of cattle in those regions, but when you start pulling those animals out, this again is something that I think this sustained long-term drought means those folks are going to have to be in, whenever they do finally get enough moisture, when they do get enough snowpack to provide summer water for surface water, those regions are going to be in rebuild mode, which means we're going to probably support feeder cattle prices going into 2022 again. Not going to rehash corn prices. This is just OMAHA corn prices. They're really, really high. I use OMAHA because they're in the middle of cattle feeding country. This means it's going to be more expensive to feed cattle. So here's what, based off of Kansas feedlot closeouts, we were around 77, 78 cents on feeding costs per hundredweight. just got back some information on some cattle that went to Iowa that we sent in August that came off in January and February. They were very, very similar to this cost, between 75 and 80 cents on feed cost to gain. For that was for steers and heifers. But with $5 corn, easily we're going to be back up to, we'll be hitting 85 to 90 cents feeding cost to gain with $5 corn if it persists for very long. Very, very quickly, this is the May futures market for feeder cattle. We've had some really nice steady prices since the middle of January. Some opportunities. Prices have started to slip for the March, April, and May contracts. The problem is the futures market has been more optimistic than what actual feeder cattle prices trading in the country have been. So until we start to see some increase in the feeder cattle index price, which is a 12, the actual sales in that 12-state region out west, we're probably not going to see much support in the futures market for these spring contracts anymore. That doesn't mean that they won't bounce back up to 142, 143, 144. I'm not saying it won't do that, but it's hard to imagine that these prices are going to make some tremendous strong run this spring, especially in the futures market, to provide an opportunity to do anything. I'll tell you what I did do. I have a load that myself that'll go out somewhere at the end of April, 1st of May. And Aaron mentioned puts, being able to put a floor in, and then he said lowering that, being able to lower that premium, which I'm guessing he was, suggesting using a fence, which would be selling a call, or you could use a bare put spread, which would have been selling a much lower put, just to reduce the cost of your floor. I actually did both of those. So I actually started with purchasing a 142 put for April, and then I sold a call at I guess it was $8. Gave me an $8 window there that I wasn't going to be out any money, but I could gain $8. And then when the market collapsed, I actually bought that back, and then I entered into a bare put spread. And so in doing all that, my point of doing all that doesn't matter exactly how it works. I mean, we can sit down and discuss that. I'd be glad to do that with anybody. But I've only got about $1 per hundredweight in a floor price of 142 for my cattle. And that makes me money on those cattle. If those cattle have performed like I suspect they have performed, and if they continue to perform the next 2.5 months, then those cattle will be profitable at that price level for me. And I think the reason why I say that is because as we look at August, we fell off the August highs, but we're still at a pretty high price for August feeder cattle. The September, October, and November feeder cattle prices are actually a little stronger than the August. And so there are some opportunities, if I'm not mistaken, and I'll just act like I'm talking to Aaron here. Aaron, I think the basis in August for an 8-weight steer in Tennessee is around $5 or $6. So if we traded at right at 152 yesterday, that puts us at a 146 feeder cattle price, which is probably $10 to $12 higher than anything that we see trading right now in Tennessee. That is probably a profitable price for most people. I know that if you're buying feeder cattle right now, or if you're weaning calves right now, that you're going to background, there is money to be made over what the selling those at freshly at weaning is. But with that, here's some just fed cattle price forecast. We're not going to push much past this. For the first quarter, it's going to be hard to average over 115. We just can't push past that. But that second quarter average, which is where the focus is now, 116 to 120. Do I think we're going to have some weeks over 120? You bet. I really think we have that opportunity. But the overall average during the second quarter will be probably around 118, 119 type area, and then moving on into third and fourth quarter. But here's where most people are going to be sitting And you can pick your 5 to 6 weight steers. You can pick your 7 to 8 weight steers and heifers. Of course, the 7 to 8 weights are always in load lots. I show load lots because that's how most of our cattle that are 7 to 8 weights are moved. Otherwise, they're moved at much lighter weights. So when you look at this, I do have right now, I do have August at 148 to 152 for those steers. Heifers, a discount, but not a terrible discount. We're not looking at too terrible of a discount on those heifers. But with that, I'll leave this screen up, and well, I tell you, if you've seen enough of it, I think that's yeah, I think that's about it.